Good morning, everyone. My name is Eloise Hall, Interim Head of National Accounts here at Kensington Mortgages, and welcome to our latest webinar, Growing Complexity, the Rise of the Specialist Customer. We have over 1,000 mortgage brokers set to join us this morning, so thank you so much for taking the time out of your diary for us today. As our regular attendees will know, these webinars are developed on the back of your feedback, so please do get involved and submit your opinion after this session and let us hear about what you want us to talk about next. For those that follow us on LinkedIn, firstly, thank you so much. We've just hit a new milestone of over 15,000 connections, so thank you for staying in touch with us. We also use our LinkedIn page for our webinar series, so if you haven't yet followed us, please do take the time and connect with us on there. We recently created a LinkedIn poll asking our connections which area of the market they believe they will see the highest growth in this year, looking at specialist categories such as adverse, the self-employed, those looking for more affordability, and even green seekers. The LinkedIn poll revealed that 42% of brokers believed adverse will be the biggest specialist growth area this year. 27% believed affordability will play the biggest role. 15% believe self-employed will be the biggest growth area, and another 15% thought green mortgages will be the biggest rise this year. And this morning, I'll be discussing some of those areas of the market with our industry experts. But before we get into the day and the agenda, let's just run through some brief housekeeping tips. So the first thing to mention is that on your screen, you will have a control panel. Within that control panel, you will have the option to submit questions throughout the day, and my colleague is on hand behind the scenes to answer any of those questions that you might have. If you do come across any IT issues, please do utilise the same function and we'll get in touch to make sure we can work through any problems that you might be experiencing. But a classic IT tip that we found is to simply log back off and log back in again using the same webinar link, but making sure to select computer audio. If you haven't selected computer audio today, there may be parts of the webinar that you will be unable to hear. So please do take the time to make sure you're logged in the right way. We will be emailing out some of your CPD certificates after the session today, and we are expecting to run to around 60 minutes this morning, and your CPD certificates will reflect that as well. So let's have a look at the lineup, and it is a great lineup that we've got planned today. So first up, we have Alex Maddox, Kensington's Capital Markets and Digital Director, who will be giving us an update on the latest market trends and changes in the mortgage market and our industry. I will then be joined by Kensington's own Francis Cassidy and LDN Finance's Chief Operating Officer, Greg Cunnington, and the Mortgage Mum's very own Shelley Walker for a panel discussion on some of those growth areas that we expect to see this year. And last up, Francis Cassidy will also be back on screen to give you the latest Kensington news. But first up, Alex Maddox, our Capital Markets Director, recorded a mortgage market update for us last week where we highlighted changes in the market and mortgage performance. So let's give that a watch now.
Hi, and welcome to a market update from Kensington Mortgages. For those of you that don't know me, my name is Alex Maddox. I'm the Capital Markets Director here at Kensington. And what I'm going to do is take about 10 minutes of your time and run through an update on what's going on with inflation, which is obviously a key topic for the last few months, and the the impact that's had on market interest rates. I'll then talk a little bit about what we're seeing in mortgage rates and the link between those, and then move on to the housing market, and then finally onto mortgage activity and a little bit about performance of mortgages given the quite substantial shock with the cost of living crisis that we're all very aware of. So let me jump straight in. So in terms of inflation and interest rates, I think we're all very aware of this rapid growth in inflation and the CPI numbers that you can see there in the left-hand chart. I mean, significantly above this 2% target that the Bank of England has had for a while. And I guess the good news is it is beginning to come down. But I think the chart just shows the scale of that move up in inflation and really quite unprecedented move, both in its speed and also the height at which it's got to. And the good news is that a number of the market commentators are expecting inflation to drop down within the next 12 to 24 months. I've seen some as bullish as expecting inflation to drop down to 2%. others sort of more to the sort of 4 to 5% in the next sort of 12 months. But there's still quite a lot of variability between those different forecasters out there in the market. But you say the good news is that it is starting to come down a bit, and you can see that in that sort of green line that's beginning to turn. When it comes to interest rates, that's the Bank of England base rate in the left-hand chart, and you can see there those moves where not quite as rapid as the drops we saw after the global financial crisis, but I think there's this 11 rate rises in the recent past, with the central bank pretty much taking rates up to where they were back in 2003, 2004. So for those of you of a similar vintage to myself, you would have seen rates at this level or even higher. But certainly an awful lot of people out there, and sort of some younger mortgage customers, first-time buyers, really won't have seen interest rates, or won't have been aware of interest rates being at these kind of levels. So quite a shock for many customers and people out there across the country. Swap rates is a key driver of the cost of borrowing money for sort of 2 years and 5 years. You can see in the right-hand chart here, and you can see how they rapidly increased as a result of both the mini budget and inflation, and so a very, very rapid move there, and again unprecedented and in a very, very long time. And so these are important because they're generally used by most mortgage lenders to price their 2 and 5 year mortgage fixed rate mortgage deals, just because that's the cost of hedging out the fixed rate portion of the mortgage. And you can see there they went as high as 5.5% as a result of that mini budget, which we all know too well. But luckily they've been coming back down again, and they've pretty much stabilized, certainly for the 2 year rate, at about 4 to 4.25%. And then for that 5 year rate, it's stabilized at about 0.5% lower than the 2 year. And the reason that the cost of 5 year swaps is below the cost of 2 year swaps is because broadly that says that the market expects interest rates to go up and then to come down at some point in the future. And that's really reflecting the view that after inflation comes back down, whether that takes 1 year or 2 years, at that point then perhaps we move back to a more normal market of base rates around 3.5%. But the implied peak base rate is still in the sort of 4.5 to 4.75 range, according to market estimates. So that infers that there's still some more rate rises to come in the short end in terms of the base rates. But I think the swap market is sort of pricing these in already. So actually, if those rate rises were to happen, it probably wouldn't impact swaps significantly. So a lot been going on over the last few months. Just going to look at the next page and talk a little bit more about inflation. And I think here what we try to show you here is the components of inflation and what's been driving inflation up over this period. And you can really see that blue bar, which is housing and household services, includes a lot of the energy for the cost of living, electricity, gas, etc., has really grown massively, and we all know the reasons for that. War in Ukraine. I think one of the other big drivers was transport, which is that sort of light green close to the top of each bar chart. I think the good news here is that that has actually come back down. So yes, it was horrible, but as the base effect, as they call it, starts to wash through, and just year on year prices don't necessarily go up because prices have just reset and are stable at this new higher level. So I think that's one of the reasons why inflation is beginning to come down, is this reduction in the transport leg. So let's just move on quickly to mortgage rates. And as I said, I think very closely linked to swap rates, but initially let's just talk a little bit about what sort of volumes we're seeing. And I think this chart on the left is incredibly informative, and again another very rapid move. And what this shows is the split between different fixed rate terms. So if we go back to sort of 2015, 2016, the majority of customers took out a 2 year fixed or less, 60-65%. There was very little more than 5 years at that point. And that's gradually been declining, and it had dropped down to being just under 50%, as you can see in sort of 2021. But then we've seen a rapid move lower. So that's now just 20% of mortgage lending is done on 2 year fixes or less or shorter. And as you can see there, there's been a little bit of uptick in loans greater than 5 years, but really the big growth has been in that sort of 2 to 5 year product. And I don't have the data, but my estimate would be that is almost entirely the 5 year products selling very well. And one of the reasons is they look relatively cheap compared to the 2 year products, and that's because that swap rate is about 0.5% lower in 5 years than it is at 2 years. And also, I think customers are looking for the stability, and there may also be of locking in their rate for 5 years, and also there may be some affordability benefits depending on each particular lender's affordability rules. So that's volumes. On the right-hand side here, you can see mortgage rates. And the SVR there, typically this is tracked base rates quite closely, but with a spread of about 3% over base rates. And that's why it's sort of, as you can see there, with base rates of 4.25 right now, the SVR is close to 7 on average across the different SVRs tracked by the Bank of England. And then you can see their mortgage rates, how they spiked up to sort of 6% after the mini budget, and like swap rates did, so typically about 0.5% higher than swap rates, and they've started to come back down again as swap rates have normalized. So still well above where they were in 21, but at the same time going back to where they were pretty much sort of after the GFC. So hopefully, as inflation drops, we might see those swap rates coming down, and I think that will help to drive down mortgage rates further. So now talking a little bit about house prices. This is on the left-hand side here. You can see the LSL price history, the house price index, which is the blue bars, and you can see there that actually, they had some sort of pretty tough months back in sort of 21 and early sort of 22. But for the last few months, it has been positive, albeit at relatively low levels, and certainly some of the other price indices have actually been showing some sort of declines in the recent past. And something that we look at quite a lot is the RICS, the surveyors. They send out a monthly market survey, which is useful because it's a very sort of forward-looking leading indicator of the housing market. And that also is sort of this net balance of surveyors who think prices are going up versus down. You can see that's gone pretty negative for quite a while now. So surveyors are really expecting prices to come down, and not quite so much as it was a month ago, but they're still expecting prices to come down. They just expect them to come down less than they were before. And I think the general view from the surveyors in the most recent report was that the number of buyers have reduced as well. But having said all of that, if we look at the right-hand side here, house prices have shown very substantial gains. If we look at London first, which is that green line, you can see there a very rapid rise through 2014 and 15, stabilized from 2017 onwards, then took another sort of push up, really during COVID, although there has been a little bit of a correction, as you can see in the last few months. Southeast England was slower to react, but did sort of reach that sort of plateau in sort of 2018, but then saw a very rapid rise. And again, I think this was linked to COVID and a lot of people moving out of London and buying properties in the sort of commuter belt. It'll be interesting to see as more people go back to work in London, whether that sort of normalizes and maybe we see that sort of some pressure on the southeastern market as a result of that. And then finally, one we always show is the northeast. Really very little price appreciation for a long time, but you can see even that market has continued to do well since sort of pretty much the start of COVID. So on the final slide here, just talking a little bit about mortgages, volumes, and the green line there is mortgage approvals, and you can see the rapid drop that I'm sure you're all feeling in the business that you're seeing. Does seem to be reversing in some of the illustration data we see, but that's the Bank of England series there. Land registry series in terms of property sales hasn't shown that decline yet, although it is a very volatile series and it does tend to get revised quite a lot. It may also be that it's a bit of a lagging indicator, as in by the time the property sale gets registered with the land registry, they put their data together and they send it out. it could be quite a lot later than the Bank of England is able to provide that data on mortgage approvals, which typically comes through in the monthly returns from the regulated mortgage lenders. So my view would be that that blue line is going to drop quite significantly, although the green line is beginning to tick back up again. And then the final chart from me today is one on UK mortgage arrears. And as I said, we've all been sort of feeling the pinch from cost of living, higher interest rates. Really, there's not much out there that's positive, albeit maybe the only positive out there is unemployment is staying remarkably low throughout this period. But really, from the arrears charts, you can see they're both on the 3-month arrears, months in arrears, MIA, and the later stage arrears greater than 12 months. We really aren't seeing any pickup in our book. I think all mortgage lenders and mortgage administrators are watching very carefully. We're resourcing to make sure that we have adequate people to support customers if they do get into trouble. But really good news. We're not seeing a pickup in arrears, and therefore, I'm not seeing that roll through to more repossessions and property sales coming through. So, in summary, inflation seems to be moderating. Interest rates seem to have stabilised as a result of that. The housing market is definitely under pressure, and I think that's true both in sort of volumes and value. But the good news is the consumer is proving to be pretty resilient, and mortgage customers are able to pay their interest rates from what we're seeing. So that's a great outcome. So with that, I'll leave it here, and I'll hand back to the team.
Wonderful. Thank you so much to Alex for that excellent insight and some really good data there. Great to see mortgage arrears staying low amongst the turbulence in the marketplace, at least for now, and hearing how low the unemployment rate is and remaining at record lows. Alex did record that session for us last week, and I wanted to give you the latest hot off the press figures so I could confirm to you this morning that as of today, 2-year swap rates now stand at 4.52%, and 5-year swaps have also increased and is currently at 4.01%. So 5 years have just creeped back over that 4% mark, which they have been under since the end of February, early March of this year. And as a result of this, it may be likely that we start to see some lenders increasing their rates this week or next. Alex also discussed the fixed rate shock some customers may be experiencing, especially first-time buyers or those newly into the market. And I read some research from Uswitch around how younger customers are 50% more likely to take out a tracker rate mortgage than a customer with more experience in the marketplace. And I'd be interested in hearing your experience of this. If you've had any feedback, please do feel free to write a message in the chat box and let me know, is this what you have been experiencing in your business? And lastly, on the back of Alex's presentation, it was amazing to see mortgage performance looking like it might be starting to move back up after the lull from the mini budgets. We've also seen property demand growing and sales inquiries from Rightmove returning to healthier levels, which the figures show inquiries are up 8% versus the same period from 2019. So still a few bumps in the road, but it seems like we are making progress on the right path. But that's likely enough from me, and I would now like to welcome our expert panel to the screen. I'm joined today by Shelley Walker from The Mortgage Mum, Greg Cunnington from LDN Finance, and Francis Cassidy from Kensington to discuss and debate some of the changes within the specialist market. So please join me in welcoming them onto screen now. To our panelists, thank you for joining me on screen. Francis and I are very appreciative to be joined by some of the industry experts this morning. So thank you to Greg and Shelley for joining us this morning. The topic of the webinar this month is the rise of the specialist customer, and we've already started to see demand change in customer needs over the last few years and in fact months. One of the biggest triggers for this has been the cost of living crisis, and this year Step Change, the debt advice charity, released some data showing that they had seen a 38% increase in customers calling concerned about their debt and finances. So that's roughly around 300,000 additional people this year alone concerned about the cost of living crisis. So do we expect to see this trend continue and see more customers approaching brokers who've experienced credit blips? Shelley, let me come to you first on that one.
Yeah, so I'm certainly seeing more people coming to me with credit blips, debt consolidation, financial concerns about how they're going to manage the uplift in their mortgage payments, as is often the case when we're looking at remortgage cases in particular at the moment. So unfortunately, I feel like this may well be a growing market, yes.
Thank you, Shelley. Absolutely, I agree. And Greg, LDN have recently set up a specialist team in response to some of that changing demand. So what's your view on that?
Yeah, I agree with Shelley. We've already seen a few more clients with kind of concerns and credit blips. I think it's something where historically we've not really seen any of it. So I'm sure I speak for the other intermediaries, you'd be told by lenders this is going to be where the market's going, and you're just not quite seeing it on the ground. But now we are. But what's interesting is it's definitely the word blips. It's not really heavy credit issues. It's not people going into kind of credit arrangements and what have you. It is literally kind of one-off missed payments, which I think has come through the stresses of suddenly having a much bigger mortgage payment or your car finance, your holidays, etc. So what's been quite interesting is seeing how lenders are kind of innovating there and taking a bit more of a manual and bespoke approach when it is just a blip. But I think we will continue to see that, because if you think about it, although mortgage rates have increased since kind of the mini budget, most people have been on a fixed rate, so not actually had the payment shock. Whereas we'll have the rest of this year and next year where a lot of those maturities will be, you know, seeing it all the time, people going from 1.2 to, you know, 4.2. It's it doesn't matter what your lifestyle is or your income, that's a big increase and a big shock, isn't it? So yeah, I don't think we're going to see any really heavy issues, but I definitely think we'll see credit blips and that kind of manual approach continuing for the next couple of years.
No, brilliant. Thank you, Greg. Good insight there. And Francis, what's your view?
Yeah, absolutely. Interesting that you say that. You guys see the customers before we do. So we were expecting these two types of customers, some looking to actively manage kind of their debt, so looking at the debt console and capital raising, etc., and then those blip customers. So interesting what you say, Greg, in terms of what those blips actually are. But it's really important for lenders to support these types of customers. And when we've looked at our policy and what we can do for them, we have made changes. So looking at the amount of utility and communication defaults that we'll accept, also going up to 90% LTV for debt console, and we don't actually use a debt to income ratio either. So I think that's good to look at. Lastly, I'll just mention, so Alex had his market update previously, and he actually said that he hasn't seen any mortgage mirrors starting to come through yet. So that suggests that customers are being able to actively manage their debt, which is really positive, which is what we want to see. So we'll absolutely keep an eye on that too.
Thank you, Francis. And I suppose it's quite timely to mention, with the new tax year coming in place, self-employed, so potentially a few more self-employed queries coming through the doors this month. But if we look back 15 years ago to the last recession, we did see at that time self-employed numbers spike in response to a bit of turbulence in the market. And I wonder if the panel believes they might see this continue, or that this kind of new trend happen again in the near future. So Greg, let me come to you first this time on that one.
Yeah, well, it's a good point. You mentioned obviously 15 years ago, and if you look at most London mortgage intermediaries, their business owners are people I was working with at the employed firm I was at, who all left at exactly that time and set up on their own. So very definitely was the case then. I think now maybe slightly less so, just because it's such a different economic condition. And if you look at employment, actually that's one of the strongest economic markers we have at the moment, where people aren't losing their jobs. Whether you see some specific sectors, particularly where people are earning commission or bonus, where people decide I'm earning a bit less than I used to, so I'm going to go off on my own and be entrepreneurial potentially, but I don't think we'll see quite the same market trend because of what's going on economically. However, just to be kind of devil's advocate with myself, I think in the last couple of years we just have seen a drive towards the self-employed market anyway. So more people starting their own business, being entrepreneurial. But I think that's just something we've seen in the UK as a whole, and isn't actually specific to what's going on economically at the moment.
Brilliant, thank you, Greg. And Shelley, let me come to you next on that one.
I think it's quite trendy now to be self-employed almost, isn't it, and to be an entrepreneur. So you often see a lot of that on social media. So I don't know how much that's driving trends, but I certainly had a month last month where I just contracted 3 clients in a day to deal with their remortgage needs, and all 3 of them have just gone self-employed within the last year. You know, so it's definitely happening. Mixed industries as well, you know, so down to sort of people taking on their own gardening business just because they want that freedom and flexibility, and they're sort of sick of the daily churn or sick of being stuck in front of 8 hours of Zoom meetings. Now they're not in their offices, right up to, you know, people going out there with heavy investment models and things like that. So quite a mixed bag, I would say, from my own client base, and more interest in self-employment, I think, driven potentially by this social media sort of hype around it, if you want to call it that. But sometimes people not fully understanding what it means to be self-employed, you know, and some of the additional stuff that we have to do when we work in that way. But certainly for me, I would like to see some enhancement on self-employed offer in the market, particularly around 1 year self-employed, particularly around people that have changed the legal entity of their business. You know, that seems to be a more regular inquiry, and even contractors, you know. So these are some of the ones on my desk that become a little bit more challenging at the moment, which I know you guys are great tools in.
Yeah, and accountants do tend to have this way of always picking the moment exactly when the customer needs a mortgage or remortgage to say, oh, actually, let's change the structure of your business at that point in time. So that's really, really good. And I think you're absolutely right. It did become very trendy. Also in the pandemic, really, we saw a lot of new people starting self-employment then. But Frances, let me come to you next. What's your thoughts on this?
That was a nice link, actually, Shelley, because self-employed is absolutely what we do at Kensington. That's a big part of our business and what we feel we do really well. Definitely your 2 types of customers. So the ones that are looking for I heard it called a side hustle, so something alongside what they're doing in their main employment. And then potentially, if unemployment rises, those customers that are either losing their job or being made redundant, etc. So those 2. We did some research a little while ago at Kensington, and we looked at self-employed and employed customers and how much savings they had. So I think the stats were an employed person has around 31 days worth of savings, whereas a self-employed person has 6 months worth of savings in case anything goes wrong. And based on that, we know from our experience from things like the pandemic, all the areas of the mortgage market are going to be affected. So lending to someone, in our opinion, that has more provisions is a no-brainer. And like you said, Shelley, flexible criteria like 1 year's trading, absolutely, that's what we can do. What I think is really interesting is the attitude seems to have rubbed off from the lender to the customer. A customer, if you're self-employed, don't think that they can approach a lender and get accepted for a mortgage. There was a figure that said around 40% of self-employed won't approach a lender. And I have a friend actually who only a few months ago, she's self-employed, she's a first-time buyer, small deposit, but a few credit blips, went direct to her bank and did kind of like an online journey. And she got declined. And I think that's a really important thing for us to think about, is how we get hold of those customers and how we can service them, give them advice as a broker and what that kind of looks like. So yeah, lots of things going on there, but definitely support from lenders and therefore brokers needed.
That's good to hear that, Frances, because I just think you always kind of look at it when you look at your back book, and you've got high street lenders will go, great, this client has just started an employed position, they've got 1 pay slip, they're in a probation period, that's the safest thing we've ever seen. Oh, this client doesn't only pays themselves small salary and dividends. Yes, they've got lots of retained profit, but we don't want to look at that or view it. But actually, that's the client who, if there was a blip in their employment, they've put everything in the business, so they're going to be absolutely fine at the other side. So if you do take that more holistic manual approach, it's a kind of safer applicant. And you're spot on the kind of intermediary side. I'm sure Shelley sees the same, but self-employed clients kind of stay with you for life, because the options do vary every time a remortgage or house purchase comes up. And if you do have a high street lender who is just taking salary and dividends, if that client has just gone to their bank, they might suddenly be told they can only borrow 1/3 of their borrowing capacity and be very disappointed and distraught. Whereas actually they could have got their dream home quite easily by just speaking to an intermediary. So I do think self-employed clients, the intermediary channel is is obviously the perfect fit.
Yeah.
I'm very biased, I know.
I agree, of course.
And an obvious link to that, Greg, obviously with our recent acquisition by Barclays, we've got a high street lender and a specialist lender that do very different things. How can we, and it's very topical for us internally at the moment, how can we look at that journey and help those customers going through? So the whole Barclays Kensington piece, that's very topical. So hopefully we'll see some movement there soon as well.
Exciting.
Lenders coming together and having that sort of pipeline that you can pass clients between as they sort of progress on their self-employment.
I mean, I won't say it's an easy process to go through. I think
sure.
systems and technology being an absolutely huge part of that. But yeah, watch this space. It's definitely something we want to innovate and be involved in.
Absolutely, and I think all of that does really highlight the importance of intermediaries in this space as well. Having a broker that knows exactly which lender they need to be placing that business to and understanding the criteria is a huge advantage for those customers that are unsure and have been told time and time again they can't get a mortgage at the high street or in other scenarios. So absolutely, I think that's a really great strength for the intermediaries out there. The next question I wanted to pose to the panel was 2023 is absolutely going to be a very different year to what we've experienced over the last couple of unique years, I shall say, with the main takeaway being reported that this will be a very PT and remortgage predominant market. So I just wanted to ask, what's the panel's view on this? Are there any predictions, any top tips perhaps for some of the brokers out there that might be experiencing a different year to what they used to have? Shelley, let me come to you first as a mortgage broker.
Yeah, so traditionally my business is sort of 50-50 purchase and remortgage, and we spoke with a lender recently and they said the same, you know, but they're predicting it's going to be more like 70% remortgage product transfer and 30% purchases. So that seems to be what the market is indicating. So obviously we do need to focus our attention around these clients that need remortgages and product transfers, and perhaps market differently to attract them in by telling them, giving them the added benefits that they can have, because I think it's very easy for people to just feel like they should stick with their lender, just pick their rate, you know, roll over onto a new deal. But as we know, that's often not the best circumstance for them. They're often stuck with the same term, or they might not be able to do the additional borrowing, or they're just not getting the best rate out there in the market for their circumstances as they stand today, particularly if they were previously a specialist client and perhaps now they're not. You know, so that'd be a really good opportunity for people to review their needs and move them onto the mainstream market. So I think we need to adapt as brokers and change our marketing and sort of explain that to people so that they are really understanding that. I know there's a lot of debate about broker fees and you know, what we should be charging in these circumstances if people can do things directly, but obviously it is about that added value that we can bring. And I would like to see lenders across the market being flexible with rates post-submission, post-offer, you know, but even on product transfers, because we know there are some lenders that, you know, if you put it in and you've agreed it and accepted it, that's it, you know, even if it's got a delayed start date on that new product. So I think there's a bit of change and flex that's needed on both sides, but it's around really helping people to understand the value of looking around, even if it just feels like the easy option to do that product transfer yourself.
Yeah. Can I just interject, Eloise? Shelley, how do you find the information you get from a lender about when a PT is going to come up? So your communication from a lender to let you know that a product transfer is coming up for a customer and that you need to contact them. How do you find that?
I think in most cases that's driven by ourselves, you know, so I don't have many cases where it's highlighted to me from a lender that the date is coming, is looming. So I think there is a tendency for lenders to want to keep that business themselves and process that themselves. But it would be better, obviously, if we were working together. But I guess the risk to the lender is then that we move that client elsewhere, you know. So I understand why it's like that, but it would be better for the sake of the client, you know, and treating the customer fairly to give them that opportunity, obviously, to re-review their case and truly get the best deal for them on the market.
Yeah, okay. Thank you.
But I do think it's key, that we're on top of our back book, and that we're contacting people early so that they are aware of this, because sometimes if the client gets a letter from the lender directly before the broker, they'll just do that, and then sort of almost regret it, and they might well be locked into that as well.
Rightly or wrongly, maybe I thought it was across the board, all lenders would do something fairly similar. Eloise, am I correct in saying so? We'll go out to the customer after the broker, but again, signal the broker that's the person that they need to contact in that space. Obviously, there could be some anomalies if the broker's not there anymore, or there's a change in business. So I guess your internal CRM system is going to dictate part of that.
Yeah, brilliant. And Frances, I'll come to you next on that question. Anything more to add, or shall I move on to Greg for that?
I guess the PT journey. So I'll talk on behalf of specialist lenders. I mean, it's been a really challenging one. We launched our PT process last year, which has been really successful. We've managed to help lots of brokers and customers go through that journey, which is really good. But yeah, as a lender, it's been challenging for other specialist lenders who, depending on how they're funded, so if they securitize, it's very difficult to have a PT process, because your investors that you're securitizing against are expecting their return. So there's an additional layer that they need to not have that money back in the sense that there is a PT. So I think for specialist lenders out there that don't have a PT process, that's going to be important to get that sorted soon, especially with consumer duty coming down the line. Lenders that don't have one, that's going to impact the broker's decision to be able to see any potential foreseeable harm, if those are the correct wording from consumer duty going forward. So yeah, we need to support brokers within that part of the market, especially if business levels are going to be going up significantly this year and beyond.
No, brilliant.
There's always the elephant in the room about fees as well, isn't there? About commissions, if you like, around product transfer versus remortgaging elsewhere.
Yeah.
So we'd urge lenders to review that as well.
I think we're quite competitive in where we are and what we pay for PTs, but I think across the board, the amount of work that goes into all these variances with your customers needs to be addressed.
Yeah, absolutely. And Greg, I'll come to you lastly on that.
Yeah, I found that was one of the points I was going to make, because we've seen a very similar pattern to Shelley. So the purchase market is still there, but it's inconsistent. It seems to be demographic split. So the large loan market is still strong, but below fairly quiet. But we are doing a lot more PTs. I know I met one of the big high street lenders last week, and apparently we've done as many PTs in Q1 as we did for 6 months last year, which we were both not sure if that was good or bad. It was like, okay. I think that's where as intermediaries, we've always got to be careful what we wish for, haven't we? If you think after the mini budget, there was a lot of noise from intermediaries about lenders, what are you doing? We need a 6-month window, not a 3-month window. We need easier PT systems. And I think now you've got some firms going, oh, our income's dropped because the procuration fee's half and we can't charge a broker fee, and all we're doing is PTs. So my kind of view on it is always just do right by the client, and long term that's the best thing for every business. So where you do have a world where the PT rate is almost identical to the next best remortgage rate, which is normally the case at the moment, by definition you will be doing more PTs, and that is what it is if it's the best option. But similar to Shelley, what we're seeing a lot of clients who actually do want to release equity, whether it's home improvements because they're not moving now because of the changes in rates, whether it's they're moving to interest only, which some lenders won't let you change repayment vehicle when you product transfer. The LTVs tend to have come down because obviously the property market has done very well in the last couple of years. So I think it's exactly that. As long as we're in touch early, and as long as we're doing the full advice process holistically and going through everything and actually what is best for the customer, there are still a lot of remortgages taking place. But yeah, there is a drive towards PT, which is understandable. And I suppose the elephant in the room is the buy-to-let market, particularly in London and the southeast. PTs have become particularly dominant because of the ICR requirements. But again, unfortunately, that just is what it is at the moment.
Yeah, absolutely.
Yeah, some good insight there, Greg. Thank you for that. And good to hear you mentioning about purchases still being out there, because although I think we all agree it is going to be a very PT and remortgage market, I think it's important we don't forget about those purchases that are still ongoing, and first-time buyers within that as well. So it's good to see that demand returning back to the market again after the lull post-mini budget. So I did see some interesting data actually from money.co.uk, which shows around 70% of first-time buyers used a mortgage broker last year, which is a great number, but that's in comparison to 83% of the rest of the market that used a mortgage broker. So I thought that was quite interesting. What's the panel's thoughts on why first-time buyers might be using a broker less, and what can we do to encourage more first-time buyers into the market? Frances, I'll let you go first this time.
Well, I used my scenario earlier of, you know, my friend who didn't think that she could get a mortgage being a first-time buyer. I think that the products out there are important, and I'll probably touch on that bit, because then what we need to see in the market is more lenders supporting more initiatives. So shared ownership's a really obvious one. 80% of all the shared ownership applications are first-time buyers. And with Help to Buy obviously ending in England officially, definitely officially, unless anyone knows anything different, I'm always up for something else happening, then we're going to see that increase even more. And I think lenders need to be supporting those initiatives more so. But there's always new things coming to market as well. And kind of as a lender, Kensington's always been very open to looking at new propositions. As long as they're appropriate, they're fair solutions for customers, we'll always look at them. You have the obvious things that stand in the way, things like technology, mass, so the amount of lenders all doing one thing. So you've got great propositions out there, but unless you get lots of lenders and some of the big lenders being involved, then they're not going to be able to take off as they could do. So I think definitely lenders being involved in more initiatives is a way to get more first-time buyers into the market for sure.
Oh, brilliant. Thank you, Frances. And I suppose it's a little bit of that being turned down by the high street. And then, as we mentioned before, there's lots of specialist things coming into the market, like credit blips, newly self-employed. And if the high street can't cater that, somebody gets turned away from the high streets. Yeah. They think they can't get a mortgage, but in fact, they need to speak to more mortgage brokers to help them through onto that journey. So yeah, really good. Thank you. Greg, let me come to you next on that one.
Yeah, really good question. I've not heard that stat before, so you've just given me my homework for the rest of the day to actually look into that. But it doesn't surprise me, because if you think about it, Frances, right, first of all, Help to Buy going is a big deal, because that was very heavily broker-led because of the way it went through developers, the need for advice, it being quite complicated. But I think a lot of it will be marketing as well. If I think even of our own business, we put a lot of focus and emphasis on marketing, but it is very much to your professionals, your maybe higher income affluent client, you're probably somebody mid-30s onwards, so you do get more home movers and remortgage clients. And what strikes me is we had a new advisor who joined us a couple of months ago who does a lot on social media, so he speaks a language I don't understand in terms of things like TikTok, which I've never even been on, and Instagram and what have you, but he genuinely gets lots and lots of referrals and business from his social media work. And it is because I think a lot of first-time buyers will do things through kind of advertising, the marketing they're plugging into. And obviously banks by definition have much, much, much bigger marketing budgets than mortgage intermediaries. So, and obviously their advertising is going to be speak to us. It's not going to be go and speak to your broker. So it's probably where I think a lot of firms do a really, really good job on the marketing side of things. But maybe what we've not done as good a job on is using some of these new resources and channels to focus on the younger first-time buyer, who actually, perversely, in my opinion, is the person who needs an intermediary more than almost any other individual. They really, really do. I wouldn't know what I was doing if I was starting out from scratch. So yeah, that's a really good question.
Yeah. Thank you, Greg. And yeah, really good to hear about that social media piece. I think it's an ever moving beast and there's lots of new things in there, but engaging with it and understanding it more would be a really good way to grow a business. So absolutely. And I think, Shelley, that's a perfect way in actually, because your company is absolutely all over social media. What's your view on the first-time buyer piece?
Yeah, we like a bit of social media at the Mortgage Mum, certainly. So, and we do tend to sort of scattergun that across the team. So I'm sure that you would have seen it somewhere. So we do get quite a number of first-time buyer inquiries. I certainly get some, you know, a decent amount myself. I've got colleagues that predominantly deal with first-time buyers. So I think there's definitely an interested market there. But I think it's always a trust thing. You know, oh, my mum told me I should go to the bank. oh, I didn't know where to go, but I banked with this one for many years and they've never seen me wrong, you know. So I think it's just not really understanding that what they need. So it's down to us to educate and nurture people through that journey, isn't it? Because as Greg says, they're often the ones that need it the most, and we need to really invest time and energy into giving them that support and again showing the value of the broker and the offer that different lenders can bring. I think the offers that are on the market to first time buyers, there are some good ones around, but there is a need to be a bit more innovative in that space. You know, income boost in particular, you know, it's a stretch now. You know, I'm in Essex, property prices are significantly higher than, you know, 4.5 times income with a 10% deposit often. So we do need a little bit more innovation in that space. Lenders have got the autonomy to do that, haven't they, to a degree? So it'd be good to see different offers coming forward that really do support that market.
Yeah, absolutely. And I'd just say on that, I think our collaboration now with Barclays will give us more kind of reach to more types of customers and actually having the ability to be even more flexible. I like to think we're known as an innovative lender and kind of bring new products to market. So what can we do on a bigger scale? Absolutely. And I never thought we'd have an Instagram page as Kensington, so that's interesting. So that's another social way that we've come. I mean, LinkedIn for professionals is fine, but how do you get those, as a bank, do you get those customers outside, you know, those direct customers, and then get them into an advice process with a broker? So let's see if Instagram, I'm not even on it myself, so I'm not sure how it works completely, but yeah, it's interesting to see the changes within lenders as well.
I'm not quite TikToking yet. I know others are. That's definitely the younger demographic.
5 years maybe.
Yeah.
I hear there's a lot more to TikTok than just dancers, and there are lots of mortgage professionals on there that are doing other things than that. But no, really, really good. Thank you, everybody. It does bring us to the end of our questions, actually. So hopefully that's provided some insight to the intermediaries who are watching today. And just wanted to say a huge thank you again to Shelley and to Greg and Francis for joining us this morning and sharing. Thank you again, everyone. Shelley raised a very interesting point at the end there around income boosting products and affordability challenges. And just to bring that to life a little bit, UK Finance released some data around the LTI gap in different regions. In London, for example, the average LTI required is 12 times income. And in the Southeast, it's 9 times income. And if you're based up north, like I am, in Yorkshire, it's 6 times income. So some very big challenges in the market, regardless of the north-south divide. Kensington has been working on some solutions. So from our Heroes product range, which offers 5 times income to key workers, to our Young Professionals range, which could offer 6 times income for certain professions, our High Earners criteria, which again offers 6 times income to those with large household incomes, and even to our most recent product, Flexi Fixed for Term, which offers an affordability boost, as we don't have to stress test the rate and affordability, as it is a fixed rate for the term of the mortgage with flexible ERCs. So if you don't know about any of these products, I would urge you to reach out to your Kensington BDM. You can find their details on our BDM map on our website. On the panel debate, we also discussed the opportunity with first-time buyers and getting them to reach out before they go directly to their bank. 40% of first-time buyers used a referral to a mortgage broker. So if you have any clients who have older children that may be looking to get onto the property ladder, reaching out to them and asking what their plans could be may be a good way to grow your business. And interestingly as well, there was also some research around first-time buyers, and 60% of them stated their number one thing that they look for when selecting their mortgage broker is reviews. Again, contacting your existing client base to help grow your review profile on Google, Trustpilot, or putting them on your website is a key need that first-time buyers really look for and use when selecting their broker. Kensington have also recognised this, actually, the importance of it. And so if you were to ever leave us a Trustpilot review, or your customer does, we share a lot of these on social media, making sure to tag you, your business, your network or club into that post, as we know it's not just our positive review, it's actually also yours from your hard work. So we want to share this and help boost your profile too. Now, let's move on to the next session of today, where my boss, Francis Cassidy, is back on screen to discuss the latest news from Kensington.
Thank you very much, Eloise, and thank you once again to Alex, who did our market update today. Very insightful, and again to Shelley and to Greg for joining us on the panel. So firstly, I wanted to talk about service. So I'm very pleased to confirm that our record-breaking service still continues. So we continue to be on day 1, and it's now for the 15th month consecutively. So we're really proud of that. We actually last month saw 43 cases offered in less than 48 hours, which for us internally is a record. And hopefully that's some of your cases coming through that we've been able to service for you. Since we've launched our product transfer service, we've actually helped nearly 900 brokers in putting a case through. So after months of development, we're really pleased to be offering that service to you. Encased, of course, in Trustpilot. So we ask you and your customers for scores, and we're very pleased to say we're consistently at 4.5. So thank you very much for that. I also want to talk about products. So since the Barclays acquisition, what we've been able to do is realise a lot of the funding opportunities that we have and reduce the rates across our range. We've also been able to evaluate our risk appetite. So when looking at the business mix we do within our proposition, for example, the amount of buy-to-let we can do as an overall on our book, we've been able to change some of that risk appetite. So hopefully you'll see that coming through. Specifically, I mentioned buy-to-let in some of the buy-to-let products that we bought out last week. So we bought out some specials. We have a 5-year fixed rate, and we also have a tracker. So they're getting some good traction, excuse the pun, already. So hopefully have a look at those. They should have been communicated last week, but see if that's for you and your customers. I'm also very pleased to announce that we have come back into the 95% LTV market, and that's for purchase. So during the panel debate, we talked a lot about first-time buyers and how to help those customers get back into the market, and hopefully by us doing 95%, that's going to help some of your customers over there. So I'd encourage you to have a look at that. It does stand us out in the market from some of our specialist peers, so we're really pleased to be leading the way in terms of 95%. Finally, I've mentioned Barclays already, but I just wanted to confirm a few things with them. So on the 1st of March, the sale was completed. We are now officially part of the Barclays Bank UK PLC group of companies. But I just wanted to reconfirm that Kensington will absolutely retain our independence as a brand and a separate regulated business. So day-to-day operations stay exactly the same, and obviously our brand, which we've been spent a lot of time and hard work building, will absolutely stay the same. I mentioned the financial strength and reach that Barclays do provide us in terms of funding, obviously, but it helps us just increase our competitiveness in the market. So we will obviously always look at our products. We're an innovative lender, and that will absolutely continue, but hopefully you'll start seeing that in some of our pricing as well. Lastly, I just want to reiterate that nothing's going to change in the way that we do business with you. We'll still be able to access our products and all our services in exactly the same way, so nothing's going to change there. Lastly, once again, thank you very, very much for your business and your continued support. Anything else that you want to feed back to us, we're really grateful for feedback, be it on Trustpilot or on these webinars, and we really want to hear what you think. So thank you very much, and back to Eloise.
Fabulous. Thank you very much, Francis. Kensington is absolutely leading the way in service levels for lenders, and not just in the specialist markets. We are very proud to have maintained the service level throughout the turbulence of last year and to continue this into 2023. So we are definitely busting the myth that all specialist lenders are slow or difficult to work with, as that couldn't be further from the truth here at Kensington. And please let me echo Francis's appreciation. We wouldn't be the lender that we are without your business and support. So thank you for all of the cases so far this year. As I mentioned at the start of today, to make sure we are talking about the right topics in these sessions, your feedback is really appreciated. So when you exit the webinar today, you'll be presented with a short survey. So please do take the time to complete this and let me know what you'd like to hear about next. Like today's webinar, it's all created on the back of your feedback. You should see on screen now the LinkedIn and Instagram logos for us to be able to connect with us. So please do follow us on LinkedIn and Instagram, where you can receive all of our latest news on our webinars, but also competitions and information about product changes, as well as criteria enhancements. Today's webinar has been recorded, so if you missed any moments or wanted to share with your colleagues, we will make this available to you later today, so you can catch up on our YouTube page. Kensington is a very unique and innovative lender which supports the market with many different options to help you grow your business as well, which now with our Barclays partnership will allow us to have even more possibilities for growth. I'd like to share with you our newest service video where my colleague Jane Atkins, Head of Intermediary Sales at Kensington, highlights our BDMs and how they can support your business, not only with our unique products and criteria, but also with the data that we have access to about your business and the opportunities that might be within your company. So thank you again for your time this morning, and I hope to speak soon.
I manage our field sales team here at Kensington. I have a team of business development managers based up and down the UK who are out there representing the Kensington brand at industry events and through broker meetings, helping our brokers and mortgage advisors to find the most suitable solutions for their clients' circumstances. I would always encourage brokers to speak to their local BDM. My team are very experienced and knowledgeable on all things specialist lending, which is especially important for brokers and mortgage advisors who are used to the more traditional high street lenders. We can help with new inquiries, how to maximise affordability, which product range meets the customer's needs, through to understanding our flexible lending criteria and broker product transfer portal. As we work so closely with other internal teams, such as our underwriters, we can help you with packaging requirements for your case and discuss what documentation you're likely to need from your customer. For me, the art of good service is in the communication. We offer face-to-face and virtual meetings depending on your preference, and using our data and analytics, we work with you to help identify possible client growth areas. We do this by reviewing the cases you've placed with us, as well as within the wider market, to help identify areas you may not have even considered. And with our extensive knowledge of the specialist mortgage market, helps us review areas with you such as business quality, speed of service and opportunities bespoke to you, adding real value to your business. We also provide broker training, such as how to read credit reports and underwriting top tips, as well as understanding energy performance. If there's anything you're not sure of, you can ask your local BDM in the first instance. Even if it isn't a new business inquiry, we can help signpost you to the best possible person to speak to. Whether it's a direct call from an underwriter or a post-offer colleague, we're here to help you get the quickest possible response. It will come as no surprise that my top tip for a broker is to get in touch with your local BDM. We have an extremely knowledgeable team that are here to help you and your customers.